What if my covered call stock price falls below strike? Imagine you've sold a call option on a stock you own, and the stock price drops sharply. What happens next? Well, if the stock price ends up below the strike price at expiration, the short call you sold becomes worthless. No one will buy the stock from you at a higher price than the current market value, so the option expires without being exercised. That means you keep the premium you received when you sold the call, and you still own your shares. This situation can actually be good news in some cases. Since the call expires worthless, you avoid having to sell your stock at the strike price. You get to keep your shares and the premium. But keep in mind, the stock's value has gone down. So, even with the premium, you might be sitting on a loss if the stock fell more than the premium amount you collected. Let's look at an example. Say you bought 100 shares at $50 each. You sell a call with a strike price of $52 and collect 90 cents per share, which totals $90. If the stock drops to $48 by expiration, the call expires worthless. You keep the $90 premium, but your stock is now worth $4 less per share. That's a $400 loss on the stock. After adding the premium, your net loss is about $310. The biggest risk in this strategy is that if the stock keeps falling, your losses can keep growing. The premium helps a little, but it doesn't fully protect you from big drops. If the stock drops to zero, your loss is the full amount you paid for the shares minus the premium you received. So, selling a call doesn't eliminate risk, it just reduces it a bit. When the stock falls below the strike price, you have options. You can hold on and wait for a rebound, or you can choose to roll the call down. Rolling down means buying back the current call at a lower price and selling a new call at a lower strike price. This can bring in extra income and help offset some of the losses, but it also limits your upside potential if the stock recovers. Choosing the right strike price is key. If you sell a call at a strike below your purchase price, you might lock in a loss if the stock drops and gets called away. For example, if you bought at $50 and the stock falls to $30, selling a $40 strike call could force you to sell at a $10 loss per share if assigned. In the end, falling below the strike price at expiration is not necessarily a disaster. It's a signal to reassess your position. You might want to hold and wait for a recovery or adjust your strategy by rolling the call down. Remember, this strategy works best when the stock stays flat or rises slightly. Large declines mean you should consider whether holding the position still makes sense for your overall investment plan.